If you've managed to scrape together $1,000 to $5,000, you've already achieved a serious milestone. Nearly half of Americans can't cover an unexpected $1,000 bill without going into debt. You have a cushion. But having exactly this much cash puts you in a weird financial danger zone. $5,000 is enough money that losing it hurts, but it is nowhere near enough to retire on or walk away from your job. So you end up paralyzed. One side of the internet tells you to bet it all on a risky startup or coin. The other side tells you to reward your hard work by dropping it on an overpriced $5,000 handbag that does the exact same job as a $10 one. Let's be honest, there is no hidden asset class that will instantly turn that $5,000 into a private jet. Anyone telling you otherwise is selling something. The right move depends on how 3 specific variables overlap in your life: your debt load, your time horizon, and your available energy. We'll cut through the hype to find what actually works for your specific situation. Long-term success relies on ruthlessly aligning your financial choices with the constraints of your current reality. To find your path, we evaluate 3 potential options. We start with Phase 1, consumer debt. The input is simple: allocate your capital to whitening out your credit card balance. The outcome is a mathematically guaranteed 20% return, instantly stopping a financial bleed. A 20% rate doesn't mean you get charged once a year. Credit card interest is calculated on a daily basis. It is negative compounding acting against you every single night you carry a balance from month to month. The trade-off is entirely psychological. Paying off debt lacks the thrill of buying a new asset or watching a portfolio go up. You are spending your hard-earned savings just to bring your net worth back to zero. It might feel unexciting, but achieving a guaranteed 20% return by killing consumer debt mathematically outperforms almost any legal stock market return you could hope to find. If you're debt-free, we move to Phase 2, passive wealth. The input is depositing your capital into an S&P 500 tracker or dividend aristocrat stocks and leaving it untouched. The outcome is a compounding growth rate of 8 to 10% annually. When left uninterrupted, the math goes to work. $1,000 invested every year over 40 years can grow into a portfolio approaching $1 million, simply through the mechanics of compound interest. This is a mathematical law that has built fortunes for centuries. It's exactly why Albert Einstein reportedly called compound interest the 8th wonder of the world. Those who understand it, earn it. Those who don't, pay it. You can also choose dividend stocks. Instead of just betting on a share price going up, you invest in massive, deeply established companies like Coca-Cola. Because they don't need to aggressively expand anymore, they reliably pay out a share of their annual profits directly to their investors. But here is the trade-off. A single $5,000 deposit will not buy your financial independence. To see real results, you need extreme patience, decades of waiting, and continuous, disciplined contributions over your entire working life. You also have to factor in inflation. The cost of living rises by around 2 to 3% a year. If your capital is sitting in a standard savings account earning less than that, the real purchasing power of your wealth is silently eroding. You are slowly losing money. Passive investing offers the highest statistical certainty of wealth preservation, but it demands a multi-decade time horizon if you want to turn a small initial stake into life-changing wealth. Finally, if you have the energy for it, we look at Phase 3, active acceleration. The input involves using a few $100s to buy a course, equipment, or inventory. This small cash outlay is subsidized by 10 to 20 hours of your weekly labor. You don't need a massive commercial loan. Buying a $100 microphone can be enough to launch a podcast, start a YouTube channel, or offer voiceover services online with minimal physical overhead. The expected outcome is the ability to drastically multiply your active income. You are building a cash-flowing asset that can completely outpace standard stock market returns in a fraction of the time. This relies on sweat equity. Because you lack the financial capital to buy a large, profitable business, you have to trade grueling amounts of your own time and energy to force that growth into existence. A successful digital skill or scalable tech business can see returns of hundreds or thousands of % in just a few years. That completely eclipses the slow, steady drip of a 3% dividend payout. The trade-off is risk. There is a high statistical probability that your project will fail completely, yielding a 0% financial return on the hours and cash you invested. Furthermore, entirely uncontrollable macroeconomic events can wipe out your active business efforts overnight. Good operators work hard for years, only to shut their doors because of global events entirely outside their influence. Active acceleration is the only realistic way to rapidly multiply a small bankroll. But to do it, you must treat your free time as your primary investment vehicle and absorb all the associated risk yourself. Your choice becomes clear when we map these three paths to three distinct realities. Avatar number 1 is the debt-burdened beginner. If this is you, ignore the stock market completely. Deploy every dollar of your capital to eliminate your high-interest consumer debt. Stop the bleeding first. Avatar number 2 is the time-poor optimizer. You are debt-free, but your career leaves you with 0 free hours. Park that $5,000 in broad market index funds, let it compound quietly in the background, and focus your limited energy on maximizing your primary career income. Avatar number 3 is the high-energy hustler. You are debt-free, you have minimal capital, but you have maximum free time. Avoid trapping a small sum in the S&P 500 for a negligible dollar return. Instead, spend a fraction of it on the skills or equipment you need to build a high-income stream. $5,000 on its own cannot buy a life-changing passive asset, but it can buy a life-changing skill or serve as the vital seed for a 40-year compound interest engine. Sustainable wealth grows when you ruthlessly match your financial tools to the specific reality of your life.